Please stay tuned after the conclusion of the podcast for additional important information. Hi, everybody. Welcome to another episode of Accrued Interest, PIMCO's podcast dedicated to serving financial advisors and their clients. I'm Greg Hall. I head the U.S. Wealth Management business for PIMCO, and I'll be your host for today's episode. I'm excited about this. We're going to take a break from macroeconomics, or at least a little bit of a break from macroeconomics, which has been the topic of our last few pods, and we're going to really delve into the world of private credit and specifically asset-based finance. To that end, I'm joined today by my partner and friend, Chris Kraus. Chris is a managing director. He co-heads the asset-based finance business at PIMCO and our private strategies group. He's based in London, but he's joining us here through the miracle of modern technology. Hi, Chris. Welcome.
Thank you. It's good to be here.
I hope you're well. Thanks for making time for this. And you've had your coffee and you're ready to go, unlike some of us.
Ready to go.
Namely Christian Clayton. Christian's an EVP here at PIMCO. He's in our product strategy group. He's focused on exactly this space, alternative and private credit. And more importantly, Christian spends virtually all of his time focused on the wealth management business. He and I work very closely together in that regard. He knows a lot of advisors. He's constantly out and about speaking to advisors. And Christian, today you kind of play the role that we've had our account managers play in previous podcasts, where you're going to be the voice and the representative for advisors as we make our way through the conversation today. Welcome.
Thank you. Glad to be here and happy to play that role. It's, interfacing with financial advisors is probably the best part of my job. So hope I can represent them well today.
Well, you're already doing a good job. I know it's pretty early out there in Newport Beach. So thanks for coming to the office early and hopping on the line with us. Let me, instead of using my own words, Chris, if you don't mind, could you tell us a little bit about yourself and how you grew up in the industry, how you got to PIMCO?
Oh, well, I started in the business a number of years ago on the sell side, structuring, packaging a lot of risk that is relevant in the markets that we're dealing with today, asset-based finance, corporate credit. Spent most of my career on the sell side, and then made the move to PIMCO back in 2010, and it's been 15 years of an exciting journey since then.
You've had a bank theme, I think, throughout your career, right? I think that and correct me if I'm wrong, but obviously, growing up on the sell side, packaging risk, helping to distribute it out to its eventual holders. And then I would imagine, once you got to PIMCO in the wake of the financial crisis, a lot of the opportunities that you were focused on sort of derived from banks unburdening themselves of different forms of risk and credit.
That's right. I mean, if you go back to 2010, right, everyone's sort of picking up the pieces from the GFC, the regulatory environments evolving. And the role that I had at PIMCO at that point in time was really helping banks as our clients and regulators, sovereign wealth funds and others as clients, trying to really unpack what was on the balance sheet for a lot of these institutions. And it's remarkable, the amount of complexity embedded in how banks were positioning risk, whether in cash form, derivative form, combinations of the two, the breadth of asset types they were carrying on balance sheet, from obviously U.S. residential credit to different parts of corporate credit around the world, emerging markets, et cetera.
Real estate, certainly, right?
Real estate, certainly. Yeah. Bank balance sheets then and still now, but I think then were especially complex, given the freedom that I think banks were able to run with during that period of time. And then obviously there was the GFC, and it was a good time to switch sides and really help clients and position PIMCO portfolios to take advantage of some of that.
I kind of wanted to start, on the bank theme, because, today we're talking about private credit. We're going to focus in ultimately on asset-based finance, which we'll define over the course of the conversation. But it seems to me that sort of the presence or absence, private credit in some form has existed for a really long time, right? There's always been sources of credit outside the banking system, non-bank lenders, but they were peripheral, prior to the financial crisis. And then as we think about since then, and really kind of your time at PIMCO, Chris, would you sort of agree with the thought that the presence or absence of banks in these markets has really kind of defined the private credit opportunity?
I think that's entirely right. I think that coming out of GFC, what was clear from regulators, and not just in the United States, but here in the UK where I am today, continental Europe, elsewhere, was a need to really de-risk their respective banking systems. And well, they each went about it in certain instances in their own way. It has, I'd say, for the most part, been coordinated. And here we are 15 years later talking about Basel III Endgame and what may be included, what may not be included, ultimately in the day. But if I go back to pre-2010 and being on the sell side, banks were the epicenter of where corporates went to get credit. It's where Main Street went to get credit. And in coming out of that period of time, with the changes that we were seeing, there was somebody needed in certain ways to fill that gap, right? I think about some of the things that we were doing, back then at PIMCO to step in and provide capital to certain markets where historically banks had been dominant. We were doing it more out of necessity at that point in time. It wasn't something that we necessarily thought of as being, hold on, this is incredibly novel, I can't wait to see where this goes. It was more of, if banks aren't able to provide risks that we find to be attractive, here's a way in which we can do it more on a direct basis. And that was the beginning of a trend that's obviously grown quite a bit since that period of time. And the banks have for quite a number of years been fighting that regulatory and accounting battle too, to try and more effectively compete in some of these markets. But I think too there's been a shift in the narrative around banks, and we even had a leading bank CEO presenting to us last week at our annual secular forum, talking about ways in which banks can partner with firms such as PIMCO and the wider private credit ecosystem in a way that's complementary to each in the banking regulatory environment that we live in today. And so, with that as sort of the destination where we're at today, going back, it's not a surprise. Somebody needed to step in and provide credit to both the corporate segments within the economy, as well as on the Main Street side. And
sorry to jump in.
Sorry.
Yeah. Well, one, I just wanted to the Secular Forum is an event we hold once each year. It's part of our investment forum series. It's an internal meeting at PIMCO where the whole firm comes together to think about the investment horizon. We do it 4 times. 3 of them have about a 6-month to 1-year time horizon. The secular is kind of special because that's where we think about 5-year trends and 10-year trends. And we invite in experts like the CEO you just mentioned, Chris, where we can talk about structure of markets over a really long period of time. So just to give people a sense of what you were referring to there. And then the other thing that you said that I think is really key is and you said it so nonchalantly, but I think it's really important that when we as a firm and others began to step in on behalf of banks because there was this capital vacuum, it didn't feel novel. It didn't feel like the creation of a new asset class. It felt like what you do when you have opportunistic capital available and there's a gap for that capital in the market, right?
That's right. And at that point in time, if I go back, it was, I recall the meetings, right, that you were having a changing regulatory environment, the requirements of originators in the mortgage space, just to use that as an example, were shifting. And, as a result, you, at the time, didn't really have anyone willing to sort of step in and be that lender. And, for us, obviously residential credit's an important part of our investment opportunity set has been for a long time. It was almost out of necessity, but also the opportunity that we saw was like, wait a second, if the market's broken, is there an opportunity for us to step in, use client capital to take advantage of what seems like a great opportunity because no one else is doing this, and it was the right time, and so we were able to acquire significant volumes, huge pickup to where we thought fair value was, and wasn't we were able to do that for quite some time before I think other people picked up on it. But I think it just goes back to your point, Greg. I think at the time we didn't think it was this massive invention. It was more of just we need to crack on and get going, and this is how we're going to do it. And it's something that we've repeated many times since then, where we've seen markets structurally just not behave in a very efficient manner that creates the opportunity for us to capture a lot of alpha for clients. So I think it's something that we just, it's part of how the teams operate. And that approach, we apply to a lot of different markets, not just residential credit in the example I was giving.
So how, and maybe this is a chance, Christian, for you to jump in as well, but like, how did we get from something as matter of fact as what Chris just described? There was a capital vacuum that banks had left in the wake of the crisis. Groups like PIMCO did what we always do, which is to find creative ways to step in and fill a capital void. How did we get from there to the quote unquote private credit industry and this phenomenon that is, sweeping the allocation strategies of institutional and individual investors respectively?
Yeah, look, I think it was a combination of a couple things. One, a huge need for income in a low rate world prior to the rate hike cycle we saw in 2022. Private credit generally was offering yields and spreads far in excess of what you get in public markets. And that created an opportunity for investors to step in and generate more return in their portfolio. And I think that was really the biggest kind of factor that drove the adoption within the wealth space. And then it was the perfect storm thereafter, where you think about 22, 23, public markets didn't always do what investors wanted, given the duration impact in 22 as the Fed was hiking rates. At the same time, private credit was very resilient. Having a floating rate asset class in a period of rising rates was a positive for investors. And so you had this combination of a market opportunity and a client need, and it was kind of the perfect storm to see widespread adoption of the asset class.
And that adoption, though, I think was relatively limited in terms of strategy, right? There were areas of the bank balance sheet that became the kind of the seed crystal for this industry, and largely focused, I think, probably on the leveraged finance desk. Is that right?
Yeah, that's right. Direct lending, floating rate corporate loans have been really within the private credit space the end all be all of most advisors' allocations. And I think a lot of the reason for that is it's done incredibly well in that period. You've had rates moving higher. That's been good for income. You've had very low volatility, even as public markets sold off. It's really delivered every outcome that a financial advisor wants. And you think about 22 and 23, when I think there were a lot of hard conversations with clients about what was going on in their fixed income portfolio. Private credit generally didn't do that. And so for advisors, it was exactly what you want in an allocation, something that's resilient when other parts of your portfolio are selling off.
Yeah, and I want to make sure we spend some time sort of just thinking about the underlying macro conditions right there, because what you guys are describing is we go from this kind of dislocation capital gap where you earn excess return by virtue of being scarce capital, in a world that needs it, to what you were describing, Christian, more of a macro-driven thesis where you're producing yield in a zero rate environment, and then you've got floating rate or no duration, type exposures in a rising rate environment. And so let's not lose sight over the course of this conversation of the macro inputs to what has made private credit successful, and let's return to kind of where we are in the cycle today. But I do think it's kind of interesting because I think, still today when the average person in our industry hears private credit, they immediately, it's synonymous with direct lending. It's synonymous with what we call sponsor finance, which is a a direct lender finds a private equity sponsor who's looking to buy a business, and they provide some form of flexible financing, usually quickly, customized, maybe with some bells and whistles that the banks wouldn't be willing to do. But I think those are really kind of considered one and the same at this point. And I think Chris is sort of here to tell us that maybe that aperture is a little too narrow, and there's other parts of private credit that have emerged and are emerging. And so, Chris, maybe I can get you to kind of help us like widen the lens here and think about the prevalence of direct lending, but also what's now coming to fore in your world.
Yeah, you're right. I mean, direct lending was sort of the only thing that was in the world of private credit for quite a while. Up until I'd say several years ago, when we began having conversations with a lot of institutional clients who, when looking at their overall alt allocations, private strategies allocations, were saying to us, at least at that point in time, look, I'm pretty full on my commercial real estate allocations. I'm pretty full on my direct lending allocations, but I know there's a very large target addressable market in what you, PIMCO, do well and have been focused on for a number of years. Can you give us some thoughts around how you could build a private strategy around those assets? And that, jumping forward, has led to what the market today refers to as asset-based finance, ABF, and that is more and more being included in that private credit umbrella.
And what is that, Chris? Talk to us about the what falls into the category of asset-based finance.
So it's a lot of that Main Street type risk that I mentioned before. The world of residential credit, right? The United States is a very large target addressable market for us in that area, as is the UK and the rest of the world. The world of aviation finance, right? We all fly on airplanes. That certainly is in scope. Auto finance, right? Auto loans that people take out, drive, get to work, get around. Equipment finance. You may think about the fleets of trucks that help deliver goods to us each morning across a given city. Someone's providing the financing for that fleet of trucks. Or you walk by a construction site, you may see a fair amount of what we call in the industry sort of yellow metal. Someone's financing that to allow that site to deliver the product, whether that's an office building or multifamily, what have you. So a lot of it is things that we sort of see and touch in our daily lives. Right? We get up, there's a roof over our head, so there's probably a mortgage there. You get in your car, you drive to work. You may go on a business trip or take a vacation. Right? You're flying. You may listen to music. That's in scope as we think about the wider opportunity set.
Those are music royalties.
Music royalties.
Yeah.
That's right.
Yeah.
So it's there is quite a bit that's out there, and that ecosystem, when you sort of add it all up, by our estimates, is at least $20 trillion, which is many times the size of the direct lending opportunity set. And I think it's been one of the reasons why you've seen that sort of expansion, if you will, back to your earlier comment about sort of the definition of private credit. I think that's why you've seen more and more parties, asset managers, look to come into this space.
How do you then think about, not to inject cynicism into this, but how do you then think about risk management in the terms of, if the banks don't want to hold it, why do we?
It's a good question. And clients will say, wait a second, why are you buying what they're selling? The fact is, at PIMCO at least, we do an enormous amount of underwriting. Right, the discipline, and I knew this years before I ever even joined PIMCO. Right, being on the other side of PIMCO and trading bonds in the marketplace, where you saw the firm operate. Now, obviously, I haven't spent 15 years inside the organization. You have front row seat to the underwriting process, to the discipline that goes into each underwriting decision, and we can't just blindly sign up to what someone else is selling. And I think it comes through in, obviously what I was talking about in terms of just credit underwriting, but in terms of how we structure, some of these arrangements where, we're looking to buy the production, let's call it, of a bank or a non-bank financial institution that's operating in these markets. We have to take an independent view around whether or not that's a good investment opportunity for our clients. And therefore, we don't look to pre-commit, if you will, to those types of forward flow arrangements. right? We'll re-underwrite everything that's put in front of us. And the decision could very well be, look, it's a pass for us or it's a no for the following reasons. And that's just how you've got to go about it.
Yeah.
But it comes back to that just discipline at the underwriting side.
I want to ask a little bit of a related question, because I think these asset classes are super interesting. They're really granular. They're all experts markets, which I think is really interesting. I would imagine the entry barriers to getting smart in U.S. residential credit, aviation finance, equipment finance. I would imagine it is relative to the direct lending model, which was the same form of credit kind of over and over and over again. Not to diminish, the underwriting, done in that space, but the entry barriers here must be pretty considerable, Chris. Talk to us about, how you've gotten comfortable with the team's capabilities to execute across all these different areas.
Yeah, the barriers to entry, I think are high. When you think about U.S. residential credit, you think about consumer, aviation, as you mentioned. You need an enormous amount of data.
Mm-hmm.
And how you source that data, I think, is really important. There are sort of the on-the-run ways of doing it. There are the off-the-run ways, the unconventional ways of doing it, where you're really trying to understand what's happening in a micro market, sort of down to the zip code or postal code level. Similarly on the consumer, enormous amounts of data that we're able to aggregate, utilize. Right, we have a very large public markets presence in these markets too, where there's a lot of data that we can see and ascertain there and feed into the models that we use and have developed. And that's analytics is the second big important leg to doing this well. Having those tools, making the necessary investments in those people, and it allows you to not only pinpoint where you want to be in these markets, but it also allows you to move very quickly. And sometimes the opportunities that we see, you do need to move quickly, right? You have a large holder that calls and asks if you can potentially take down a large transaction. We like getting those phone calls. That's PIMCO's. We've given our presence in these markets, those are the calls that you want to get, and being able to move fast can make a difference in terms of getting a really good trade, or having it go into a competitive situation. That's a big part of it. The team, in terms of composition, we always think about making certain we have subject matter experts in the areas in which we're investing.
Right.
You want to have people who really understand these markets, who have the relationships in these markets. They understand the nuances of them. They understand the origination, how to do it well. And sometimes too, markets could be expensive. And the approach we've taken with an ABF and many other strategies is making certain you have an ability to pivot, right? And making certain that members of the team, right, when something's screening cheap, we want to obviously be allocating the necessary resources to take advantage of it. When something's screening rich, expensive, let's continue to monitor it, understand what's driving that, because markets can shift as well, and then we want to be well positioned. But a lot of it boils down to making certain we can pivot across that team.
Greg, maybe I can bring in another lens here. You asked Chris about why PIMCO buys this type of risk and why we like it. I think there's an important lens on the client side of why clients should think about asset-based finance as an opportunity set in their private credit allocation. And when you think about the underlying asset class, it's quite different from direct lending from corporate credit, where you typically have hard asset backing, which should mitigate some risk in a more stressed or risk-off type of environment. You have very diversified collateral pools where I think in the direct lending space, you're seeing more and more overlap across that space. It's becoming much more of kind of a loosely syndicated market. In asset-based lending, one specific opportunity might have hundreds or thousands of underlying borrowers within it. So you get inherent diversification within the asset class. And then the last point is resilient income and accelerated cash flows. Think about a typical corporate loan where you're getting your coupon payments along the way and a balloon payment at the end. In asset-based finance, you're getting principal and interest along the way, accelerates your cash flow profile. And why is that important to an advisor? Why should that be important? It gives PIMCO the ability to reinvest in a time of volatility like we're seeing today, given that accelerated cash flow profile. And it also enhances our liquidity in a vehicle that may not offer daily redemptions, to build up a liquidity pool to meet quarterly redemptions in something like an interval fund or an asset-based lending vehicle. So I think when you take a step back and think about everything Chris has been touching on about the size of the market at $20 trillion, leveraged finance, which would be below investment grade credit, whether it's high yield bonds, bank loans, direct lending, we estimate a $5 trillion market. And so I think one of the big trends you'll see in the wealth space over the next few years is more of an adoption of asset-based finance as kind of the next leg of private credit, given the benefits that I touched on, and given you've seen some disruption in the space over the last few years that Chris really touched on over the last few minutes.
So it's great, Christian. It's a perfect kind of segue to where I wanted to take the conversation. But what I kind of hear you saying is one, asset-based finance, bigger market, less penetrated so far by the private credit crowd. The assets themselves have different underlying risks, right? They are, they lean toward the consumer, which at PIMCO, that's been a credit preference of ours in general. They lean toward being backed by hard assets, as you mentioned, and many of them self-amortizing, right? And so as the credit sits in your portfolio and pays you down, your risk to that individual credit is diminishing over time. The NAV associated with it is diminishing, and that's producing sort of the natural ability to reinvest those cash flows in different things and try to stay diversified or to make use of what Chris was describing as the agility of the team to look at different opportunity sets as they arise. So I want to maybe I'll just challenge you a little bit, Christian. Given the virtues of direct lending that you outlined rhapsodically, at the beginning of the call here, I'm curious how, and maybe we will bring macro into this at this point. How are we thinking about the cycle as it plays into choosing between direct lending, which has worked, versus maybe taking on or getting to know a newer area like asset-based finance?
It's interesting. I feel like in conversations with advisors, the tone changed late last year, late 2024. And what really started to drive a change in advisor kind of approach to this space is they were getting inundated with wholesalers pitching them on private credit. When I say private credit, again, I really mean direct lending here. And they just felt like the space was getting so crowded, giving, they might have 15 marketing decks on their deck and 5 wholesalers in their office on a given day. And so that type of competition for the space, I think, makes the average advisor wonder how much value is left there and is it over allocated to. I think at the same time, you've had a big, and to your point on the macro, you've had a massive change in terms of the backdrop, right? Think about the last 5 years. You had rates at zero moving higher. You had a very benign environment for credit overall, no real default cycle to speak of, a ton of demand for direct lending. Now we're in a world where volatility is significant, uncertainty is higher than we've seen in many, many years. I think this is the time where you need to implement a new playbook. I joke with advisors sometimes that my biggest hobby outside of work is coaching football for my kids. This is the environment we think we need a new playbook. You're facing a whole different offense, a whole different defense today than what you faced 6 months or 2 years ago. And this is the environment where we think that something that has the attributes of asset-based finance, hard asset backing, accelerated cash flow profiles, diversified underlying collateral, that's the right type of asset class for this environment. And so I don't think we're saying abandon direct lending. We're saying this is a time where the average advisor is probably overexposed that asset class, and it makes a whole lot of sense to complement that exposure to asset-based lending opportunities.
You mentioned a lot of advisors right now kind of deluged with pitches in this space or adjacent to this space, a lot of direct lending marketing going on out there. What have you seen that resonates about asset-based finance as opposed to other flavors of private credit or other things that advisors can do in their portfolios today?
Yeah, look, I think it's a couple things. Number one, when you look across the private credit space, asset-based finance is PIMCO's highest conviction opportunity set. It's a space that we think offers really attractive potential income returns at this point in the cycle, and is really well suited for the broader macro environment that we're in today. think number two, when you think about the advisor portfolio, we think that asset-based finance can really be beneficial in a portfolio construction standpoint, where the correlation to corporate credit is relatively low. We estimate it at about 0.6 or 0.7. And so this is one of those unique opportunities where you can allocate to asset-based finance, diversify some of that floating rate corporate credit exposure that advisors have in their portfolios to really hopefully enhance the return and reduce the risk or volatility of their overall portfolio. So we really think it's the perfect alignment of a market opportunity creating an attractive entry point at the same time that there's a client need. And so I think looking ahead, this is going to be an area you're hearing a lot about from PIMCO, given we think it's really an important opportunity for advisors to consider going forward in 25 and beyond.
And I think one important thing to mention, Christian, and I think Chris would back me up on this, we think the same thing about our risk preference in public and private markets. We have a view that you want to be more aligned to the consumer and the consumer economy in our public market portfolios and in our private market portfolios. And that through line is really important. It's a kind of consistent view of the world expressed through the public toolkit and the private toolkit, but the same kind of PIMCO macro process.
That's right. You're seeing that in portfolios, right? Our daily liquid mutual funds are having an emphasis on things like agency mortgages, consumer-related public credit. And then on the private side or our semi-liquid side, you're seeing an emphasis in residential real estate lending, private consumer lending. So thematically, it's tying across the platform of this preference for consumer-related risk, housing-related risk over high-octane corporate credit at this point.
I mean, I do think, one of the things I worry about, advisors are my primary constituency and my seat. And I do worry, because the experience has been so good in direct lending, that we all get a little complacent, a little comfortable, about that experience, and you kind of extrapolate that it'll continue, and we've forgotten about the credit cycle a little bit. It's been a while since we've had a real credit cycle. I think a lot of these models are relatively untested going through an honest to God recession. And I joke with advisors sometimes that, we have to remember that private credit is a really useful tool for borrower and lender, but it's not magic. We have not transcended the economic cycle. And so Chris, I might put it to you, everything you've talked about today sounds really, really interesting, but I'd suggest also doesn't transcend the economic cycle. So how do you think about, where we are today from a macro perspective, what you're looking at, and kind of resiliency through any kind of downturn that might be ahead of us?
Within the ABF universe, a couple of things that jump out. I think the starting conditions for a lot of the borrowers that are in scope for the ABF strategy are entirely different from where they were if I go back to sort of GFC. Up and down, right? You think about, household debt to GDP, we were running around 98%. 2008, you're running around 71% today. That's actually a big move when you think about just the size of those numbers. You look at debt service metrics, a lot less leverage in the households today. You look at the metrics around housing, right? You had an excess supply of housing back in 2008, let's call it, 350, 360,000 homes, where today you have a shortage of about 3.5 million homes. Right? Now, that doesn't mean that every single market across the United States is going to be flashing green, and that's the job that we have, right? To make certain that we're investing in the right markets, the right trends, the right demographics, all of that. But just as you think high level, there's a significant shortage of housing in the United States, and the U.S. isn't alone in that issue. And there's an enormous amount of equity sitting in homes. So the borrower in the ABF space isn't nearly as levered, let's say, as where it's been before. And I think you could probably point to certain companies that are financing themselves in the direct lending market that perhaps otherwise wouldn't have access to credit except for the the direct lending market there. And I do think you will see different outcomes across different parts of those two markets. So overall, we obviously from a starting condition perspective, you remain pretty constructive. The other thing that strikes me is when I look at if you look at an IC memo within a PIMCO investment, it could be 60 pages on the low end to probably 105, 110 on the upper end, depending on the transaction. Embedded within that is a lot of scenario analysis, right? What happens if we see unemployment rates jump from low fours to say 6.5? How does that sort of play through in terms of the credit performance of what we're looking at? And we're very focused on sort of the distribution of outcomes, making certain that the investments that we're making can withstand stress to the downside, right? What we try to avoid is things that have a binary type outcome. And you can see those types of outcomes in other parts of the wider private credit market where there could just be too much leverage, and without someone providing an extension, you can have losses that sort of pull through. And what's interesting, when I look at the direct lending market, a lot of return is still quoted on a no loss basis. And I think that, as Greg, you rightly pointed out, just because we've taken risks that previously may have been financed in public markets, in the public bank loan market, broadly syndicated bank loan market, or high yield, it doesn't mean that we've suddenly removed the risk of loss. Certainly, there can be cases where there's a good structure that's put in place. It's a good company. It's in the right sectors. Those types of things. But just by taking something and pulling it into the world of private credit doesn't mean it's suddenly not going to experience any risk of loss.
Will you compare a piece of private financing and say credit cards or equipment finance or aviation finance to a public market equivalent? And is there I'm not going to ask you for basis points, but is there some kind of rule of thumb that you're looking for in terms of liquidity premium, or how would you judge one versus the other?
That's a good question. We do work very, very closely with the public strategies teams, because you'll have opportunities that come to the firm, and you want to understand that relative value. Is it offering enough of a illiquidity premium versus where publics are? And it seems like a pretty simple check right at the beginning of a process. And you have seen risk trade in private markets that our view at the time, and still to today, is it's pricing through where public comps are and where fair value is, right? If we can buy, as a firm, if we can buy public ABS at a level that's wide to where somebody else just did a private transaction, well, I mean that's where you need to go, right? As an asset manager, that's not always the case, right? I mean, we certainly are finding plenty of opportunities to build portfolios in private markets, and then using public market takeouts when we see significant spread compression, and look to term out that financing. And so, the simplest, it's sort of buy wholesale finance in sort of that public ABS market and take advantage of that. But it's not always the case. There are times when those markets do get inverted, and I think that gets back to the value discipline component to private markets. If public markets have blown out and are trading wide, and private markets haven't really moved, I think you need to ask yourself, you got to be patient in those types of environments, or if you've got flexible mandates, take advantage of that by buying public market assets.
Well, I think it's an incredibly interesting area, and it's really, as we've been talking, it's really hard to distill right into a snappy marketing message. And I think that's kind of the point. We started the conversation, Chris, just talking about the complexity, of the banking system and the bank balance sheets, not just before the financial crisis, but today. And, a lot of the asset classes and areas of the market that you're talking about, they do require an expert approach, and a lot of experience in those markets, both on the public side and the private side. And for me, I don't know about you, Christian, but just putting myself in the advisor's shoes, that's my takeaway, is that we've probably reached the point in the development of this market and in the economic cycle where the answer isn't automatic, and where the trailing returns really don't necessarily suggest the forward returns, for every part of this market. And it's just going to require a higher burden of diligence and inquiry, from advisors, which is, that's not the easy message for us to send, but I think it's the responsible one at this point. How do you think about it?
Yeah, I think that's right. I mean, I think that this is one of those moments where it makes sense to take a step back and question what you're doing, and if it still makes sense for the next 5 years like it has for the last five. Like the other way I'm seeing it, some advisors approach the space, and Chris kind of alluded to this at the end with some of his comments, is by focusing on strategies that give managers a bit more flexibility to navigate in this world. Flexibility across public and private, flexibility across private credit markets, not just in the direct lending space, but including asset-based lending and other parts of the opportunity set. I think flexibility is really going to be key over the next few years. And in that way, I think advisors can make their lives somewhat simpler as well by giving managers a bit more flexibility to find those relative value opportunities, rather than always having to kind of proactively identify those opportunities themselves.
All right. Well, terrific. Thank you both for joining us. We've covered so much ground, and we could probably keep going for another couple of hours, on this topic. We might lose everybody's attention though. So we'll do this again, Chris, in a little while. We can catch back up on developments in the market then. But in the meantime, for financial advisors listening to the podcast, thank you. Appreciate you joining us. As always, if you visit us at www.pimco.com and identify yourself as a financial advisor, it'll take you to our advisor forum. That is your one-stop shop. That's your destination as a financial advisor at PIMCO, to get the information and the insight that you need to have better conversations with your clients and to navigate difficult markets. Accrued interest is part of the advisor forum platform at PIMCO, but there's much, much more available to you on the site. So we'd really encourage you to give us a visit. And also, if you enjoyed listening today and you'd be so inclined, please subscribe to the podcast. Let us know how we're doing and who's listening. We love to see that community grow, and we love to bring you new and interesting ideas each month as we record this. Thanks so much. Great. Best of luck in your practices, and we'll talk to y'all soon.
The discussion and content provided within this podcast is intended for informational purposes only and may not be appropriate for all investors. Reliance upon information provided in a podcast is at the sole responsibility of the listener. The information included herein is not based on any particularized financial situation or need and is not intended to be and should not be construed as a forecast, research, investment advice, or a recommendation for any specific PIMCO or other security, strategy, product, or service. Past performance is not a guarantee of future results. All investments contain risk and may lose value. Investors should speak to their financial advisors regarding the investment mix that may be right for them based on their financial situation and investment objective. Podcasts may involve discussions with non-PIMCO personnel, and such content contain the current opinions of the speaker, but not necessarily those of PIMCO. Other podcasts may consist of audio recording of an existing PIMCO article, and such material contains the current opinions of the manager. The opinions expressed in all podcasts are subject to change without notice. Information contained herein has been obtained from sources believed to be reliable, but not guaranteed. PIMCO, as a general matter, provides services to qualified institutions, financial intermediaries, and institutional investors. This is not an offer to any person in any jurisdiction where unlawful or unauthorized. For additional important information, go to www.pimco.com/gbl/en/general/legal pages/podcast disclosures.